with Bitcoin, cryptocurrency, crypto,
Bitcoin, crypto,
the Bitcoin, cryptocurrency, crypto.
We've seen this story play out before. Revolutionary, long-term value, and this time it's different.
So now people may have a P&L loss on Bitcoin, but I think long-term the fundamentals are quite good.
I hate to break it to you, but it's not so different this time. The decentralized finance bubble is bursting, the hype around NFTs is dead, and the trust in so-called stablecoins is long gone. To put things in perspective, the overall crypto market value has fallen 70% over a few months to less than $1 trillion. It's now tiny compared to the $100 trillion market value for global equity.
The value of Bitcoin and other cryptocurrencies has plunged. The sell-off began after the collapse of what was supposed to be one of the safest crypto assets, the so-called stablecoin Terra, whose value was pegged to the US dollar.
You might be asking yourself, is crypto genuinely dead, or is there a chance of a comeback? Well, in this video, we'll answer that by diving into how the pandemic created a once-in-a-lifetime digital asset boom. And by looking back at finance history, we will answer once and for all why crypto may be doomed to fail. If you're familiar with the crypto markets, we've seen market downturns play out over and over again. For example, in 2014, Bitcoin's price crashed when the Mt. Gox crypto exchange collapsed.
Mt. Gox unexpectedly shut down today, owing hundreds of millions of pounds and prompting the sharp fall in the value of the currency.
Hackers accessed and stole $460 million in Bitcoin. And in 2018, Bitcoin's price fell by 80% and hundreds of ICOs vanished into thin air. This time, however, the recent crypto crash followed a classic boom-bust cycle. It was driven by dynamics the crypto market has never seen before and that we may never see again in our lifetimes. I mean, if you think about it, the crypto boom of the early 2020s is a once-in-a-lifetime event. For one, we had a global pandemic. During that time, people were paid more money to stay home than to actually go and work. Not only that, people couldn't buy a lot of things due to business closures. This resulted in Americans saving more than $2 trillion. This also happened at a time when interest rates were at all-time lows, and to put the cherry on top, due to social distancing, the world was forced to go digital. This perfect storm set the stage for a digital asset boom, and from March 2020 to November 2021, the global crypto market increased by 20 times to $3 trillion. But as lockdowns started to ease, things began to change in 2022. High inflation returned to levels we haven't seen in 40 years. The Fed reversed its easy monetary policies, and people shifted back to offices and in-person events. In other words, people are no longer thinking about buying $1,000 JPEGs when higher energy prices and falling investment values make it increasingly difficult to afford rent. The decline in crypto, you might say, was due to circumstances in the economy, but in actuality, it's something inevitable like the dot-com crash. We'll get to that later though. The first significant blow that hit the crypto market was the collapse of the stablecoin, Terra USD, ticker UST, and its token, Luna. As you might know, a stablecoin is a type of cryptocurrency pegged to a real-world asset, like the dollar, gold, or government bonds, and UST was pegged to the US dollar. So it should have been a safe investment, right? The issue was that UST was governed by an algorithm and a complex system that only a handful of people truly understood. But the coins would also offer high interest payments to entice people. This scheme worked so long as new investors could pay old investors. And yeah, this is the exact definition of a Ponzi scheme. So when the founder of UST announced an interest cut from 20% to 18%, this drove large withdrawals that knocked the UST off its peg. And overnight, the so-called stablecoin and associated Luna token essentially fell to zero. Investors had left and there was no new money to pay old money. You might be thinking, so what, one coin failed? But no, the issue is that it just wasn't any coin. The Luna token market cap was valued at $41 billion at its peak in April 2022. And when it fell overnight, it wiped out the crypto ecosystem that relied on Luna tokens. There was a contagion effect. The most famous example in all this is the highly leveraged crypto hedge fund, 3 Arrows Capital. It borrowed from lenders BlockFi, Voyager Digital, and countless others.
Failed to meet a margin call from lender BlockFi. It had exposure to the now collapsed.
But when its Luna token holdings were wiped out, there was no money left to pay lenders. For a traditional bank, this wouldn't have been a big deal, but the issue with unregulated crypto lenders is their flawed risk management practices. They had lent to a handful of highly speculative hedge funds, not knowing how risky they truly were. But the story doesn't end there. Lending firms Celsius and cryptocurrency exchange CoinFlex were also forced to pause withdrawals from customer accounts, potentially wiping out life savings of regular people like you and me. The fall in crypto affected everyone, and the lenders are the biggest culprits. They offer excessive interest rates on their deposits and lend without ever conducting any credit checks. They operate as risky banks or hedge funds that pay depositors 20% on average, meaning that they must invest deposits at an even higher rate to make any money. But it's nearly impossible for investors to consistently make more than 20% per year without taking extreme risk. Extreme risk using your money. The worst part is that customer accounts are not federally insured like most bank accounts. So in bankruptcy, customer accounts are the first to get wiped out.
Crypto's market value has halved since its peak late last year, hemorrhaging an eye-watering $2.2 trillion.
The surprising thing is that the crypto crash was totally foreseeable, and the story has already played out, but in different forms in the past. For example, in the 17th century, instead of trading JPEGs, people traded tulip bulbs, and at its peak, a single tulip bulb would have traded for more than $500,000 of today's dollars. In the 1990s, we saw something similar play out, this time in the stock market. The personal computer and the internet brought an economic boom in the 1990s, driving hundreds of software and internet companies to do IPOs. This flooded the market with more stocks that degens could trade, and they traded through online brokers that became popular in the 1990s. For Robinhood, the true OG was Schwab, and by 1999, there were 457 IPOs in the year, of which 117 doubled in price on their first trading day. Sound familiar?
This GameStop situation is the craziest I think I've ever seen.
Shares roughly doubled last week on way higher than normal volume. That was helped once again by that speculative trading activity.
By March 10th, 2000, the tech-heavy NASDAQ stock index had risen to an all-time high of over 5,000 points, a 5x increase in only 5 years. Unfortunately, most tech stocks in the dot-com boom were more hype than substance. Tech companies spent more money on advertising than on building actual products. It was crazy. During this time, 95 companies that added .com at the end of their name saw their stock price increase on average by 74% within 10 days, just by changing 4 characters in the company name. But all good things must come to an end. Only 3 days after the NASDAQ had hit its peak, Japan announced a recession, sparking uncertainty in the market. Investors began to rethink their investments. That included Pets.com, Webvan, and Boo.com, all of which were disasters. They began to realize that the unprofitable companies they had invested in were destined to fail. By the end of 2001, most .com stocks had gone bust, and it would take another 15 years for the NASDAQ to regain its peak on April 24th, 2015. The big lesson here is that only companies that focus on building useful products will survive once the hype dies down. Another important lesson is that people that end up getting hurt are everyday people, the hodlers, the retail investor, people like you and me. And by 2002, 100 million retail investors had lost $5 trillion in the stock market. Retail investors paid the price of the dot-com crash, similar to how college students, teachers, and your everyday person who bought crypto and NFTs lost their life savings. The dot-com boom eventually crashed, but as we know, the internet stayed. During this time, tech titans like Amazon, Google, and Netflix were founded. And if history repeats itself, we may see the next Amazon or Google, but this time in the crypto world. There are no straightforward answers on how this latest crash will shape the future of crypto. But one thing is certain, only the best projects will survive. 92% of all startups eventually fail, so statistically speaking, we could expect a similar number of crypto project failures. In reality though, we should expect an even higher failure rate than that. The reason being that less than 50% of the top 100 cryptocurrencies provide users with any real value or useful function. And among those 100, only 36 have working products. However, it's important to remember that even though many dot-com stocks are no longer around, one only needs to look at companies like Amazon or Google to realize that the dot-com crash was not the end of the industry. Longer term, we could expect Bitcoin, Ethereum, and other leading projects to stand the test of time as other crypto projects disappear. And there are no guarantees that crypto will rebound to all-time highs. What we saw in the early 2020s may have simply been a perfect storm. But what do you think? Will the crypto economy rebound, and which leading crypto projects will continue long into the future? Leave a comment. I'd love to hear your thoughts. And if you're watching this video right now, smash the like button and hit the subscribe button while you're at it. Thanks for tuning in today, and I'll see you on the next one, Wolfpack.